Earnings, assets, liabilities, income, debt, and many other financial metrics could be easily manipulated. However, cash flow is a much harder figure to manufacture. Cash flow doesn't lie, and that's why investors use cash flow as a fundamental component when analyzing a company. Join me as we learn how to compute price to cash flow using Dell's and HP's stocks. Price to cash flow is a price multiple that you can use in combination with the PE ratio to see if there is consistency in earnings and cash flow. For example, earnings can be recognized if a product or service is sold on credit or if the buyer agrees to pay for this product or service at a later date. Obviously, there is a risk in looking at the earnings figures if then the company is unable to collect payment from the buyers or customers. But if you're looking at the cash flows, then this is no longer an issue. There are three types of cash flow classifications that you will come across when you're looking at the cash flow statements of a company. First, you have CFO, or cash flow from operating activities. Then you have CFI, or cash flow from investing activities. And lastly, you have CFF, or cash flow from financing activities. The price to cash flow ratio only takes into consideration the CFO, or the cash flow from operating activities, which simply means cash flows from core business activities, like cash inflows from product or services sold, or cash outflows for employee salaries or taxes, payment to suppliers, etc. The price to cash flow formula is the following. You simply take the stock price and divide it by the cash flow per share. The cash flow per share can be calculated by taking the operating cash flow and dividing it by the total number of outstanding shares. All right, so as usual, let's put everything into practice and calculate the price to cash flow for Dell and HP and also compare the two. As usual, I'm going to be using a Google Sheet to keep all the data in one place. In fact, I've gone ahead and already calculated everything for Dell to save us some time. So let's just do HP from scratch here, and then we'll compare the figures. So pretty much all the figures could be pulled from Google Finance. I'm just going to be using Morningstar to find the operating cash flow for the trailing 12 months, which is what we need for the price to cash flow analysis. So if we go to financials, and we go to the cash flow statements, let me just collapse everything. So if I scroll all the way here to the right, here we have the cash flows from operating activities, investing, and financing for the trailing 12 months. So in this case, I'm going to be grabbing this figure, 6.01, and that's going to be in billions for HP. Okay, so 6.01. Perfect, that's all we need from here. And now I'm going to look up the stock price in real time. Let's use Google Finance for that. So we select the ticker and then we use the price attribute. Perfect. For the shares outstanding, we can do the same. Google Finance, and then we use the shares attribute. And remember, this is in billions, so I'm going to divide that figure by 1 billion. Okay, so we have 1.2 billion shares outstanding. The cash flow per share, so that's operating cash flow over shares outstanding. So I'm going to grab the operating cash flow we just we just took from Morningstar and divide that by the shares outstanding. Okay, we have a cash flow of $5 per share, and the earnings per share, or EPS, this one we can grab also from Google Finance. And we just have to call the EPS attribute here. Perfect. All right, we have pretty much what we need. Now price to cash flow will simply be stock price over cash flow per share, which we have here. And there we go, roughly 5.87. Okay, I also added here a field for the PE ratio because I want to use the PE ratio as well to compare Dell and HP. Right, so we're going to use Google Finance here, and we're going to type PE. Right, excellent. So we have the figures here. Something I want to do first is go to Morningstar and actually checking out the technology sector index to see how the price multiples compare with the ones for HP and Dell. So I'm going to go here to markets, sensitive technology, and I'm going to click now on the portfolio tab. All right, so here we have all the index or the price multiples for the technology sector index according to Morningstar. And the first thing we can see here is that the price to cash flow ratio for the entire index is 19.17 or 19.17. That basically means that investors are willing to pay $19 for every dollar of cash flow for these technology companies. So if we go back to the figures for HP and Dell, we can see that from a price to cash flow perspective, both are actually way below the index. So for both Dell and HP, investors are paying or willing to pay roughly $5 to $6 per dollar of cash flow. If we also go and check out the price to earnings or PE ratio for the index, we see that the figure is 27.04, and again the PE ratio for both Dell and HP is also below the index. Okay. Now, at first glance, what this might tell you on the surface is that these companies are undervalued with respect to their peers. Now, something to note is that these two companies, Dell and HP, are no longer in the growth stage. These are value plays. Okay, investors are not willing to, are not expecting a lot of massive growth or increase in earnings in the coming years. So that is already reflected in the price multiples. If you look at some of the other companies in the technology sector, right, that are growing exponentially and they have, they're basically in hyper growth mode, then investors are placing a lot of emphasis into the growth potential of these businesses in the coming 5 to 10 years. And that's already been reflected in the high price multiples that we see today. For example, if you look at the Googles, Apples of the world, Microsoft, those are companies in the technology sector that have very high price multiples for that reason. So it's hard to pick one of the two given that this is an incomplete analysis. But if I had to pick one of the two between Dell and HP for my portfolio, I would probably go, given what I know, I would probably go with HP because of the PE ratio basically being a lot lower than Dell's. And what that tells me is that if the company is slightly undervalued from a PE perspective, then at least I have a chance here of a slight capital appreciation in the stock price. So I can make a little bit on that front as opposed to Dell. Now, something that is even more important to me that I actually didn't show in this video is the fact that HP, they pay dividends. They have a track record of historical dividend payouts, and Dell, they do not pay a dividend. So if I have to buy a stock from a company that is a value company that is not likely to experience growth like Dell or HP, at least I want to put my money on a company that pays dividends because that's more important for my portfolio. That's all I have for you guys. Thank you so much for joining. I hope you liked the video. If you did, please don't forget to give me a thumbs up and subscribe to my channel. I'm publishing 2 videos per week. Any comments and feedback are also welcome. Thanks again, and I'll see you next time.